Hello, everyone. Welcome to Lender Chat with KFP Investors, your very favorite investment real estate mortgage brokerage. I am Chris Fleming of KFP Investors LLC, and I'm going to start with our disclaimer as always. KFP Investors LLC does not give legal, tax, economic, or investment advice. KFP Investors LLC disclaims all liability for the action taken or not taken as a result of communications from or to its employees, contractors, clients, prospective clients, or participants. Each person should consult their own counsel, accountant, and other advisors as to legal, tax, economic, and investment matters. I am here today with my favorite CPA, Mr. David Fitch. David, tell us about yourself.
All right. Hey, Kristen, thank you. I will start by seconding everything you just said in that disclaimer. So that applies to everything I say. And the opinions and information I give is the opinion of me, not my firm, Stone, Rudolph, and Henry. So you can't hold them liable. And please don't hold me liable either. I'm a CPA here in Clarksville, Tennessee. I've been down here for 14 years now, or just about, and this is my 13th year with Stone, Rudolph, and Henry. I've been a CPA since 2011, and just living the dream down here. I'm settled in. I've got a wife and three children that are 10, 7, and 5 currently. So we're staying busy. Just moved back in March to our forever for a little while home and hope to get settled in there. We're getting close. We've got several things in motion right now as far as getting really settled in, but we did move into it in March. So just survived busy season a month ago, and now we're just settling in for the summer and hoping to get a little time off and maybe play some golf on the weekends.
Very good. Very good. All right. We are very excited here about the nicer weather and camping. We just had our first camping trip of the year this past weekend.
Nice.
Yeah. So I specifically looked for you when I was looking for accounting advice because of your experience and knowledge and history with investment real estate. So tell us, how did you get into investment real estate?
Okay, so that's a very good question and a loaded one. I've obviously, being a CPA, I've been around real estate investing mostly from a tax perspective. I did have a friend back in, I don't know, probably about 7, 8 years ago that kind of started his own little real estate venture. And I was sort of along for the ride just at the beginning to kind of see what he was getting himself into. He ended up moving to Kansas. So we're not quite as close as we were, but he was into more subject to kind of deals. He was expanding his portfolio with rentals. So anyway, that was kind of my first initial exposure from an outside perspective rather than just from a tax perspective. And then my wife and I bought a house back in 2016 that had been abandoned for about 7 years. It was an old farmhouse on an estate. Had 36 acres that came with it.
Wow.
Yes, which we didn't take all those. We split. My father-in-law was looking for a farm and some cows, or to put some cows on, and he took 32 acres. We took the house and 4 acres, and spent about 13 months bringing it to life again. It was built in 1948, so it was an older house, still over 75 years now, almost 70 years when we bought it. And we just went to town on it. As far as the bones were concerned, they were legitimate, but that was about it. It had no HVAC unit. The plumbing was all cast iron. There was nothing in the upstairs. No central air. Period. Needed new windows. Needed a kind of everything that you could think of. Just about. The only thing that was okay was the floors. Not even the walls. The walls were plaster and just struggling. So anyway, we started with that as a project, really to live in more than anything else, and we did for several years. We just moved out of it last year. Yeah, so it was just kind of by accident that's what started our venture, if you will. We spent 4 months solid actually moving into it, or working on it before we moved into it. We didn't move into it till February. We closed on it right at the end of September, and we were able to move in at that point, and then we didn't show it to the public until October. So again, it was about 13 months following that. And then over the last few years, we've done more things as we've gone along. But that got us into it, and then, or at least exposed us to all the headaches of what HG makes look so easy. And just flip the house, just renovate it. Oh, just fix the kitchen, knock out a wall. No big deal. 5 minutes later, it's done.
What could go wrong?
what could go wrong, right? Oh, is there structural stuff involved? Nah, knock it down. Um, so anyway, we learned a lot along the way. My wife's dad was a big help in that. He had done some contractor work basically on his own houses. He was building a house at the time, so he was extremely helpful in that. And we learned a lot along the way. And then fast forward a few years to I guess it was about, can't believe it's been 5 years now, but about 2018. And my wife, she does real estate photography, she does staging, and she was kind of involved in that. And she's like, man, I'm making pennies on the dollar of what these investors are making, and I'm
Mhm.
giving them advice, I'm taking the pictures of it, I feel like we could do this. And I told my
Mhm.
wife, well, there's a it's a considerable investment that they have in it that we don't. You go and stage, they give you $100 and you're done. They put down
Right.
100,000 to try and get 125. So I said, there's a big risk there, and me being an accountant, I'm fairly risk averse. So she took some working on me, and I finally was able to be convinced that it might be a viable option. And as everybody knows, that was really when things started taking off. So we got our first one. Basically, we used our house since we had bought it at such a low rate, and we invested our own equity from our first house that we had bought as collateral. We took a HELOC out on that house, so that way we could buy cash. Because when we were looking for our own house prior to buying that house, we found out real quick that buying foreclosures is pretty much impossible if you don't have cash. Investors will beat you every time. They can close in 10 days. They don't have any kind of appraisal requirements. That was really killing us. We just couldn't win any, even if we offered 15, 20 grand. And this was before over asking price was like a thing or a popular thing.
Mhm.
It was just impossible. We would offer 20 over and we'd still lose because of the hassle that went along with it. And most of those were VA foreclosures, and they just wanted to get rid of them. So anyway, we're able to use our house as collateral and get a HELOC, and that got us in our first flip. And since then, we've done, counting that first house, we've flipped 10 houses here in the last
Wow.
5 years. So, and that's, yeah, well, being a CPA full time and my wife taking care of the three kids, homeschooling them. So it's been our kind of hobby on the side. We've
Right.
done mostly, none of them have been huge. Not like our initial house. Most of them are just kind of flooring, painting, new kitchen appliances, countertops. I think we might have done cabinets in one of the houses, but not
Mhm.
humongous renovations. Most of them we had bought and sold within 2 or 3 months.
Oh,
So
wow. Okay.
that was kind of my strategy because of how risk averse I was. I wanted to
Mhm.
have as much or as little liability as I could for as short amount of time as I could. And they
Mhm.
eventually got a little bit longer as we got more comfortable with it and had more equity to kind of work with. And the last one we did was probably about 3 months or so. It was a bigger
Mhm.
one, and bigger risk, bigger reward is generally the
Mhm.
the goal anyway. And that one turned out well also. So right
Mhm.
now, after we um, bought this last house, we are kind of looking again. We're still
Mhm.
trying to get somebody. That's what I'm telling my wife. She's still sending me houses left and right. She is the brains behind the operation. I'm the finance and the
Uh-huh.
calculations. So she just
Uh-huh.
sees the potential and all that kind of stuff, and I try and make it work. So anyway,
Uh-huh.
that's kind of my perspective. Not only do I do a few hundred tax returns a year that have all kinds of rental properties and investment properties and that kind of stuff. So I know the tax perspective inside and out, but that
Mhm.
gave me the exposure to the actual doing and the all the things you run into along the way. And we've
Right.
ran into plenty. It seems like everyone is a little bit different. You run into something different when you're trying to close or
Yes.
listing it, and you get crazy questions from potential buyers and stuff. But anyway,
Right.
we're somewhat experienced, I guess, at this point. But we do another one, I'm sure we'd run into something else that'd be new or original. So
Right.
that's a little bit about
Right.
my background there.
Yeah. I just to piggyback on that, I regularly have investors ask me from the financing standpoint, like, what is everything you're going to need? What do you think we're going to run into? And the truth is, I just don't know until we get there. I
Right.
never say it's 100% done until the documents are signed and the money has changed hands, because there have been too many times weird stuff has come up at the very last minute and I'm
Hmm.
going, what? So, yeah. So, for towards your statement about, we'll see what we get into, same,
Yes.
same with free file.
Yeah. So if I knew now what I knew then, I definitely would have a different perspective the first time. I mean, my wife and I were like doing cartwheels the first time we got our initial offer on the
Yeah.
first house we were flipping. More so me than her, because I was always worried that, what if we can't sell it? What if we can't make what we're asking? Whatever. And little did I know that 3 weeks later they walked, and they were able to do that. They got their earnest money back, and I was like, "What in the world? What is this contract for?" And found out real quick that those are, more of a suggestion than anything else. And if everything goes well, then this is what's going to happen. But if they don't like something, then they're gone. So, we found that out real quick. And now, like you said, till I'm sitting at the closing table, and even at that point, I'm still not like 100% sold. I want the money in my bank account. Then I'll celebrate. Let's go out to eat.
Exactly. I have an originator who closed a file Thursday of last week, and he said, "Can we pop the champagne down?" I said, "Nope, not until we get paid.
Let's
Nope,
get funded.
not until we have money."
Mhm. Yep.
So speaking of, your or several hundred tax returns that you do every year that include investment real estate,
Mhm.
is there a frequently seen mistake that you wish more people, real estate investors, knew about? What can we do better from a tax perspective?
Mm, I've got a laundry list here, but I'll probably focus on the top two or three.
Okay, that's a good idea.
Okay, all right. The first one really is just record keeping, and I know most people that are into real estate, that side of their brain is not as active, and they hate it, and I don't blame them. I mean, that they give me a day job, so I actually appreciate them to some extent. But it's a little more difficult to reproduce things like a year later, especially if you have multiple projects in motion, which is not
Mhm,
uncommon, 2, 3, 4, 5 plus.
mhm,
So as much of a pain as it is, highly recommend just keeping track of the properties either with an accounting system, and I'm not here to endorse any in particular, but a lot of our clients, QuickBooks Online is fantastic. You can use classes and separate by property, that kind of stuff. Whatever you can do to make it easier on yourself. And this isn't necessarily a mistake, but having a separate bank account is pretty helpful along the way, especially if you are have multiple properties involved. It's not as easy to distinguish, what's income, what's personal, just transfers, what's personal expenses, what's business expenses. So definitely recommend having a separate bank account for your investing activities versus your personal activities. One thing that I run to a lot, especially in the last 3 or 4 years, with the market doing what it did and people selling a lot of their properties because they could double their money on them, and why not take that and invest it into 2 more properties or whatever, um, was just the element of depreciation recapture, which is somewhat just, I don't even know if misunderstood is the right word, or is maybe not even known what that means exactly and how that comes into play. I'll kind of go over a brief overview, but when you are renting a property, let's just say for 5 years, you get to take the initial year, 27 and a half years of the property. So to use round numbers, if you have $100,000, you divide that by 27 and a half, you get roughly $3,500 a year, almost $4,000 a year you can depreciate, because basically the asset is being used by a tenant.
mhm.
So you take that depreciation each year and it helps offset your income. So if you have $5,000 of rent income, you already have $4,000 depreciation. So once you add property taxes, interest, if you have a loan on that property, insurance, management fees, supplies, maintenance, all that stuff, usually you get a loss from a tax perspective.
Mhm.
The thing is, since you're taking that loss, you're reducing your other income by the loss because you are depreciating that asset. Well, when the when you sell that asset, the IRS says, "Hey, you've been taking a deduction for an asset that you just sold. So now you get to recapture that depreciation." So 5 years down the road, that's 14, 15 grand or so that you have to pay tax on, in addition to any gain that you have. That comes as a shock to people a lot of times. Especially have people that maybe aren't as heavy into real estate investing. Most real estate investors, if they're selling 2 or 3 houses a year, or even every other year, they've run into that before, so it's not a shock to them. But it's the casual ones that maybe pick up a rental property, or they just move and they can't sell it, so they want to rent it, whatever. A lot of the ones I see around here are military. They go to a new post every 3 years,
Mhm.
and they buy a house, and then they move and they rent it out. It's got almost like a retirement plan. If you go to 7 different posts, you have 7 different rental properties, which after 20
Right.
years might be almost completely paid off, and now you just have great passive income. And there's nothing wrong with that until you start to sell them, and you've been depreciating them for X amount of years. I just had a client that couldn't believe he owed, I think it ended up being about 10 grand, which really wasn't bad, because he had over $100,000 gain, but he just wasn't ready for it because he just doesn't see it very often. It's a very real
Right.
thing. You are depreciating that property, and just a little caveat on that too is there's a lot of strategies out there as far as like cost segregation, things like that, to try and accelerate depreciation, especially on rental properties, where people will separate, the cabinets, the flooring, the appliances, rather than just depreciating $100,000 building. They break it down into parts. So the building might be $50,000 and the flooring is 10,000 and the appliances are 5,000, whatever. They assign values to it, and those tangible property like appliances and flooring and cabinets can be accelerated as far as depreciation goes. The only problem is when you sell it, you're recapturing even more depreciation. So it's not something you can't do. It's just a matter of being ready for the bill when it comes. So
Okay.
that's one big thing that I see a lot that I hate giving. I mean, nobody likes to give bad news, but especially when it costs them money, it's not ideal. So anyway,
Yeah,
that's
I've had a
something that
little
to
bad
keep in
news
mind.
from you before. I didn't like
I know. I'm sorry.
it. Wasn't as bad as I thought it was gonna be though.
And that's what I
So
shoot for.
yeah. um and so one of the reasons that I wanted to have you talk to us is um I see the value certainly in so many ways, particularly with real estate investors. They're very can-do attitude, gumption, and and I love those qualities. But there are times when it's important to hire a professional, and so I would like for you to, do you have an example of why it's so important to use a tax professional instead of perhaps taking your tax advice from some YouTube videos or uh, the latest guru?
Or the conference that you went to and sent me a slew of questions.
That too.
That too.
Calling me out.
Maybe a little, but no, it's not just you. Believe me, all year long, I get emails, I get phone calls. Hey, I heard this, or hey, my friend is doing that. Um,
Uh-huh.
all the time, I get those questions, and I mean they're valid questions. If they hear it, they might as well validate it. Make sure they're not missing out on something. Because I will say that I have probably 600 or so tax clients. I mean, I talk to my clients as I can throughout the year. When I talk to them, when they bring me their stuff, I try and get a feel for their information. But I mean, I'm not with them 12 months out of the year. So stuff could
Mhm.
be happening that I'm just not even aware of, and I can't help with those things. So it's good for my clients to ask me questions about things that they're running into or could be running into, just because I am human and I don't know everything that's happening in your tax potential situation. So I don't discourage those kind of things at all. But as far as why to use a professional, um, I, I'm not even sure where to start. I think is what I wrote down. But would you go to court without an attorney? I mean, I don't think so. Would you? I mean, some people do buy houses without real estate agents. I've done it, and
Uh-huh.
you can get by sometimes, but you might miss some things, and
Uh-huh.
that's really what I bring to the table is my experience. So seeing 600 tax returns for several years, I've seen thousands of tax returns, and that experience and seeing all those different situations just allows me the perspective to know pretty quickly, hey, are we missing something as far as the deduction goes? Are we
Mhm.
capturing all of our data? Are we staying compliant with all the laws out there? If you're going to be a real estate investor, there's certain policies, there's elections that can be made. You can elect to treat all of your rental real estate activity as a single activity. So if you have 20 properties, you can treat them all as one, whereas the IRS automatically treats them as individual units unless you elect otherwise. You ask why that's important. Well, there's certain rules that go along with being a professional, a real estate professional. It's what the IRS refers to it as. But in order to meet that requirement, you have to have at least, and I shouldn't have even started this without having the numbers in front of me, but I believe it's 500 hours. Participation might be 750. I don't remember off the top of my head. It's one of those two. I can answer that later if you're really curious, or you can Google it and you'll find it pretty quick. But anyway, just knowing those things, those nuances, just like you as a lender and just as a real estate agent, they've seen a million, well, not yet, they've seen thousands of contracts. And so they know, what line number to look at. Line 600 might be your clause to ignore a inspection. You don't have to get an inspection, but you have to waive the inspection, right? So, they are familiar with those things. Whereas if you were to sign a contract to buy a house, you might not know that that's buried on page 6, and you might just totally gloss over it. And now you don't even have the right to inspect the property. So things like that are just normal for me, just in my day-to-day, activities, seeing all those tax returns. So that's part of it. And then really, I think you'd also ask the difference between tax prep and tax planning. I'll just segue into that.
Yeah, please.
I ran into an audit for a client that wasn't mine. The return that was being audited was not one I prepared, put it that way. And she got a hold of her CPA, but it was a bad time. It was right around Christmas, and she was going to be out of town, and said, I'll try to get to you when I get back. And her IRS agent was, as I don't know if aggressive is the right word, but she did not give her like a minute more than the minimum amount of time of like 10 days to respond to the initial audit interview, where you're supposed to get one scheduled. And so she actually assessed her $40,000 of tax. And at that point, then you basically have to prove that she disallowed all of her expenses, is what it came down to, on her as a real estate agent, that were on her other expense line item. It had details, but the IRS essentially just questioned all of them, which they have the right to do. I mean, you are basically verifying that information is accurate and have the ability to produce evidence that it is valid and necessary expenses. So long story short, she came to me and I said, this is not something we usually do, since we had prepared the return, but I can't leave you high and dry. I mean, I can see your tax return. There's no way that these are not somewhat valid expenses. So anyway, I walked her through the process and ended up, as a CPA, I can deal with the IRS directly. So, heaven forbid you were to get audited, which knock on wood won't happen. But if it did happen, you wouldn't even have to deal with it. You would just have a CPA for that. And I mean, you could be there for the phone call, the initial interview, if you wanted to, but I probably wouldn't let you talk, and you wouldn't want to talk. There's no reason to. That's why you hire an attorney. That's why you hire a CPA. And I dealt with that audit, and at the end of the day, she went from 40 grand to like $1,200, and the 1,200 was actually quite valid. And I did not argue with it, and she took my word for it, and we went with it. It was just a mistake by the preparer, which it happened. We're also human, but regardless, the opportunity for us, or the ability really for us to intervene with the IRS, is one of the most valuable things about us. I mean, when you think of preparation versus planning, or even just a professional versus non-professional preparing taxes, there's so many avenues now to file your tax return. The IRS has free file. Obviously, everybody in the world knows about TurboTax. H&R Block is out there, and they're going heavily online to basically compete with TurboTax. And can you prepare your tax return? Absolutely. Do people? Yes. Do they get it right? Sometimes. If they come see me, then that means they probably didn't go very well. And the way I compare it is, it's almost like fast food versus a steak dinner. What do you need? I mean, sometimes the fast food will get you by. If you just have a W-2, I can't add any value to that tax return. I can help you sleep better at night, maybe, because I've seen so many of those, and I know it went to the right place. And I literally have clients that know that I can't add any value, but it helps them sleep at night, that I prepared it and I signed it with them, and that's that. I even tell them, you can do this yourself and save yourself some money, but that's what they want to do. Whereas there's other people that go a little bit further than they should, and they end up in trouble, and then it costs more money on the back end to pay me to fix it all than it would be to have just done it right the first time. So
yes. Let's just say that a little louder for the folks in the back. It costs more money to pay me to fix it than if you just hired me in the first place. Yes.
That's it. I'm sure you're aware in your field how things can go.
Well, I can't tell you how often again, on the financial side or the financing side, I go, you did what? Why did you not talk to me before you did that? And, they were doing it themselves and trying to figure it out. And
yeah, I'm sorry. That would be probably the other number one thing. If you can have more than one number one thing, is if you do have a tax professional or a lending professional or whatever, contact them before you make decisions, big decisions that you think you know the answers to. I love when you give me potential scenarios of, hey, we're thinking about doing this with the retirement thing. What'll what are the repercussions, or what are the consequences, or what are the benefits? That's great. That saves so much time on the back end. I have clients all the time that will invest in a Roth IRA. They make over $204,000. Well, we don't get to take that. You can't even contribute to a Roth. I think that's the number. Let me check my little thing here. 214. I'm sorry, it changes every year. 214 last year. And then you've got more work to do on the back end, because
Right.
now we have to recharacterize and all that kind of stuff. But I've run into some big ones. Just this past year, someone thought, and this is one of the things I wanted to bring up, because they started, this guy owned a business, right? Schedule C business. He was I think he was into concrete coating, did very well at it. Well, because he had so much net income, he thought, hey, I need a building to operate my shop out of. So I'm going to buy a property with an LLC. He was already a single member LLC himself. That business was. He opened up another single member LLC and bought that building in the LLC name. He took money from the first LLC, the original one, made a contribution or a loan really to the other LLC, used that to purchase it, and thought he could write off the entire building as an expense. So I think it was cheap. It was in Kentucky. It was like 135 grand. And he expected to reduce his net income by $135,000. And I had
Did he
the,
do
unfortunately not. I had the less than fun privilege to say, well, you can't rent from yourself, even though you're an LLC. That's disregarded by the IRS. They don't care. LLC is a state thing, not a federal thing. It makes no difference if I have 8 LLCs, the IRS doesn't see any of those. They just see me, and it all goes on my personal tax return. So that was the first problem with that. Second problem is, if he would have bought it even in his own business, as we talked about earlier, you have to depreciate it. You can't take a real property asset and just write it all off at once. So I mean, he could take, I think it's actually worse. Commercial is 39 and a half years rather than 27 and a half. So there was even less to depreciate. And I mean, I hated it for him. And he already spent the money. That was the other problem, is he took the cash and used that. And I always, if people talk to me on the front end, I caution them, if they're having a great year, that's great. Don't just use all that money. Talk to your lender and see if there's a way you can, utilize a lower interest rate, maybe 3-4%. You can deduct the interest expense anyway. Now, again, that's not 100% deduction. That'll be reduced at your tax rate. So maybe 25-30%, which is still better than paying 100% of the tax expense or the interest expense. But it gives you that liquidity so you can pay taxes. I can't tell you how many clients I had, especially during the boom, which, I mean, I know the market's still okay, but it was crazy there for 2 or 3 years, where people were netting $150,000 on what properties they only paid $100,000 for, and then they just go buy another house, just cash. I'm like, I mean, that's great, but you've got a $150,000 gain, which means you're paying $20,000-$30,000 of tax, and they just couldn't believe it, and they didn't have the cash to pay it. So, you can use financing and cash hand in hand to, make sure you're keeping up with your investments and still expanding, but also have the liquidity you need to pay your tax bills.
And just so folks know, by the way, you can buy the property with cash and then come back to us for what we call delayed financing, so that you can still expedite the purchase and
Mm-hmm.
use financing for leverage and still have money left over to get your bad news from David.
Yes. And actually, that goes into another thing you had mentioned, the tax planning, which I hinted at a little bit. That's a huge thing that all CPAs offer, not just me. That really makes the difference between TurboTax or even H&R Block, where I'm available all year round. And so I might not be able to reduce that $25,000 tax bill, but I can have you ready for it. And being ready is a whole lot better than being surprised in April when you ain't got $25,000 or you can't get it easily. It's going to cost you even more to get it. So that's the kind of stuff we want to avoid. So I meet with my clients, or I reach out to them generally in November and just, see, do you want to have a discussion? Have you had anything big take place? Do we need to discuss anything? And if so, let's do it now. And then we can see if we can do anything about it, because there are some options before year end. After year end, you're basically out of luck unless you can fund like a SEP IRA or something along those lines. But if you have a business and you want to, purchase a truck or a piece of equipment that you're going to need anyway, then, it's something we can discuss before year end, and we can manage or delay some of that tax, which is one of our major strategies, is trying to defer tax as long as we can. So at some point, we don't think the tax rates are necessarily going to go down. but hopefully your income will go down, and then when you're retired, you're not bringing in as much, you're in a lower tax rate, you'll pay less tax on that income.
Thank you.
Mm-hmm.
Speaking of, are there any significant changes of which we should potentially be aware that maybe have occurred this year or will that you anticipate coming soon?
Not as many as I thought. If you had asked me 2 years ago, I would have thought the whole tax code would be different, to be honest. Because I mean, Trump changed things tremendously back in 2017. Was a Tax Cuts and Job Act. Everything took place basically in 2018 and was effective through at least 2026. And we expected with a new administration a lot of those things to change. But because of Congress being the way it was, I think it was split for a little while. I think it might still be split. I'm not trying to get into politics too much. I'll get upset. So really, no, is the answer. We have not seen any significant changes here lately. There aren't any huge ones on the horizon. There are a few retirement changes that are coming into play in 2023, 2024, but nothing significant. Mostly just favorable things, allowing individuals to contribute more than they have in the past, but nothing huge. We've been looking for the corporate tax rate to change again because it's as low as it's been like ever at 21% flat rate. That hasn't changed. The qualified business income deduction, which was implemented in 2018 to kind of offset some of the corporate advantage, that's still there. The depreciation factor, that one is actually changing a little bit, and I'm glad you did ask that, and it came up. So right now you're allowed to use bonus depreciation all the way up from 2018 through 2022. You could 100% depreciate a piece of equipment, basically anything that had a useful life up to 15 years, without even having to what we've referred to as Section 179 it. The difference being Section 179 depreciation, you cannot take a loss. So say you have $20,000 in net income, you buy a $40,000 F-350, well, F-350, $80,000 F-350, and you have what could be up to a $60,000 loss. Well, if you can only take 179, that'll stop you at zero, and you can carry forward the depreciation to the next year. However, if you wanted to show a loss of $60,000, you could take bonus depreciation, and that'll take you to loss, but you'll offset other income. So if you have real estate investment income, or if you have W-2 income from your wife's job or your husband's job or whatever, then you could pay less tax that way. Whereas again, 179 doesn't give you that option. Well, starting in 2023, it's actually going to be reduced to 80%. So it's going from 100% to 80%. And then next year, 60, and then 40, then 20, then it's going to be essentially phased out completely, I believe, in 2026.
Gotcha.
So something to be aware of. It's not really that big on the real estate side. It's more for business owners that are trying to depreciate equipment and things like that will come into play. But otherwise, nothing huge that we're aware of or have seen yet.
Very good. Thank you.
Sure.
And so back to your own personal real estate portfolio, what are you getting into now?
Not sure. So the last year, like I said, we bought a house that we call it a flip. That really wasn't the intent. The main intent was to get what we could out of the house that we bought 7 years ago and see what was in it, because it was such an unknown. Being a farmhouse, 75 years old, and as much as we invested into it, we didn't know. And obviously the market went up a whole lot from 2016 to 2022. So that was kind of the main thing. We wanted to move to the other side of town, which that house got us to. And we redid the kitchen, and we put in all new flooring and paint, a few things here and there. But that one essentially we broke even on, which was the goal. And we did. And then we bought the house that we're in now. We actually bought this one at an auction, which was a first for us. It was a live auction, which is extremely nerve-wracking, I can assure you.
That sounds very exciting.
Yes. My wife was excited. I was trying to finance the thing, and you only have, I think, 45 days to close is what they give you. And it was a significant. Yeah, right. No big deal. But anyway, it worked out okay. So we moved into that one. So now we're kind of, we got the previous house sold and everything. So we're back kind of at a spot where we're looking. We've looked at a few different things. My wife really wants rental property for whatever reason. I still have not gone that direction. I know a lot of people do. I do a lot of tax returns for people that do. It just still not part of what I want as my portfolio. But we're probably looking I think we're getting close to having foreclosures again, that are reasonable. They're still kind of ridiculous right now. They just started getting listed here again in the last probably 6 to 8 months once there was that COVID basically exception where you couldn't kick anybody out of their houses. Nobody could evict anybody, which I mean, I understood where they were coming from, but at some point, landlords can't afford to pay for houses that people are living in and not paying them. So that had
Right.
to end, and I think it finally did. And so we've seen a few foreclosures, but we've also seen the banks get a little more shrewd and hire some contractors to do some quick little fixes and then list it at a stupid price, which we're in Clarksville, so it's not quite as bad as Nashville, but list them for 170 or so a square foot. Whereas when we first started, we were buying them at 80, 85 a square foot, which is never going to happen again that I can foresee. But to us, a reasonable one right now is more like 135 to 140. But because banks are investing a little bit, they're asking almost, I mean, like private owner sales prices for a foreclosed property. Even with a little paint, it still is not updated nicely. It's not updated, it's just been painted. So anyway, we're just keeping our eyes open, kind of looking for that next thing. We're sort of interested in condos. We've looked at a few of those to some extent to maybe get kind of our feet wet with a rental. We're also looking for my parents are kind of looking to get to this side of town as well. They were over in the other side of town where we came from, and just kind of looking for them to maybe finance it ourselves so they can get their place sold, and then maybe have them move in or something like that. So we're just kind of keeping our eyes open. We're getting, I think, closer to where we're starting to see more availability as far as houses go, but still, I still feel like they're a tad overpriced.
So you are more interested in a value add proposition or flipping, whereas your wife is more interested in long-term hold.
Yes, I would say that. But my wife is interested in anything. So if there's a house that's for sale, she probably wants it. She went and looked at one last week with my brother-in-law. He's getting married here in a few months, and so he's looking
Yay.
for his first house. And she went and looked at one with him, where we were gonna potentially finance it for him because he's in the same spot we were, 15 years ago or 10 years ago, to where, I mean, trying to buy a house under $200,000 is almost impossible unless you have cash. Or the ones that are available are in just such horrible condition that you can't get a loan on it. So, we were going to try to help him get into it and get it fixed up to where he could, like you said, do the delayed financing and get his own loan on the property and just kind of bridge that gap for him. But she went and looked at it, and it must have been bad, because I think this is the first house my wife said that she wouldn't even make an offer on it. Anything close to what they were asking for. I could put you in contact with my agent, and he would be stunned too, although he was there for it. But she has hardly walked into a house she didn't like or have a vision for. That's her thing. She can see the finished product when she walks in, and she loves the challenge, loves getting it there. So yeah. Anyway, that probably is more of our perspective, but. We'll see how it plays out here.
Yeah, I think I'm kind of personally, I'm kind of straddling the fence there, that I don't want to do the real estate things, but I want to invest in real estate. So I have been buying 19% of other people's properties. So I get to share in a little bit of the appreciation, the depreciation, the cash flow, all the things, but I don't have to do the rental part. Yeah, yes. Because I'm not good at that.
Yeah. I just don't like other people using my stuff potentially.
Yeah.
Wrecking it.
Well, before I let you go, this is my favorite question of any interview. If you could give your younger self 3 pieces of advice, ideally real estate related, but not necessarily, what would those 3 pieces of advice be?
Okay, that's a great question. And I did actually prepare for this one. And I've made it real estate related, so at least mostly. First one would be probably take more risk. Calculated is what I put in parentheses. Calculated risks, because it took a lot for me to get into my first one, and now looking back, I probably missed out on a lot of opportunities just because I was probably overly cautious. And I mean, nobody knows what the market's going to do. Nobody knew it was going to like triple or at least double in a couple of years. But we had some pretty good opportunities present themselves that we passed on, and I probably would have done well with that. Again, not stupid risks, but ones that look like they would have paid off, they probably would have, is what I've learned over the process, because of how um, pessimistic is what my wife calls it. Realistic is what I call cautiously realistic. I make my budget and I have got a number that we need to hit. And if I don't think we can get there, then I say no. And usually I'm more than cautious with it. But regardless, I'd say one would be take a few more calculated risks if the opportunity present themselves, because then you run into a dry spell like we have the last year or two, and they're a lot harder to come by. And it'd been nice to have a couple that I didn't. But regardless, that would be one. One would probably be to explore the buy and hold a little bit more than I am. You already heard my aversion to it, but some of the houses that we started with, not knowing the lending that you have available, I think we could have done real well. If we would have held those for an extra year or two, could have went a long way and increasing the profit by $20,000-$30,000 and not costing us more than maybe 3 or 4, just because me, it was all about cash flow and liquidity and wanting to just get my money back out of it so I could invest into the next one. And the way I went about it was I used it to pay off our house. And so once we had done that, then it was just, we wanted to build a shop. And so we did that. So I'm very debt averse, but debt can be used wisely. And house debt is really the best debt. I know I'm preaching to the choir here, and this is not any kind of plug for you or any lenders, but I've learned.
No, plug away. That's great.
Plug away. I'm sure you're okay with it. But I've learned that there is a very, like, the cost of money is a real thing. And if you can make 10% in finance and you only have to cost you 4%, that's still a win. 6% is better than 0%. So I probably could have done a little better with that 10 years ago or so, or I guess 8, really 7 was when I started my investing. But I was so averse to it, I probably could have started before that and done okay. And then the third one is, I kind of already led into it, but debt isn't the worst thing, especially good debt. I mean, bad debt, credit card debt, that kind of debt is no good. But if you're talking about, especially real estate investing, you can really leverage things. And that's kind of how I've been working now. Is the person I'm working with is we basically take a line of credit out on the house that we're purchasing. And we've done that for our last 2 houses. So I have equity, generally enough equity in the house that I'm in to put down at least, I don't know, 20, 40. I think the last one was like 70% with the house I was selling. And then the house we're purchasing, you take out 20, 30, 40%. And that way, once I sell the house that I'm getting out of and purchasing the new one, I already have a HELOC in place. And the HELOC is paid off when I sell the house. And it helps bridge that gap a lot better, because that was one thing we were always worried about is, what if we move, we buy a house and we have 2 mortgages and we're in between and it takes 6 months to sell instead of 2 months, can we float it that long and all that kind of stuff. And this makes it so much easier, because all we have to do is pay the interest payments essentially for those 2 or 3 months, which generally the last one's only 1 month. So it's really not that big a deal, but it makes it so much easier. You can still get in without all the major contingencies, as far as, the appraisal is so much easier to meet when you only got to meet like 40%. They barely, half of them don't even go out and look. They just drive by. Yep, there's a house there. We're good. So it helps. And not everybody can do that, but it's an option. So, and it's good debt, in my opinion. If it helps you accomplish your goal and it doesn't cost you very much, and you have the ability to make a lot more because of it, then that is a good debt. So a lot of people, me included, can be extremely debt averse, but it's not necessarily the best strategy. There's more out there, and I think you've even mentioned that you're a lender, so the value of it, and it can really, you can accomplish goals and make profit that you couldn't make otherwise. So
right, yeah. I mean, like you said, some percentage of something is better than 100% of nothing.
Of nothing. Yep.
So, but to use it wisely, we don't want to over leverage.
100%.
Yeah. So for your personal network, what resources are you currently seeking? How can we help you?
It never hurts to have a lender on hand for that hard money financing. I've got clients that occasionally reach out to me for that. That's probably the main thing. And then, word of mouth is how I continue to grow my practice, my business, if you will. I'm hoping to be a partner here in the next couple of years. But still, I've got my own network of clients that just continues to expand, just based on people like you, referring me to friends and just getting me out there. And I'm happy to take care of my clients. I enjoy it, especially if it's something that I'm passionate about, like real estate. I feel like I can add value to the situation and not just. I mean, I can prepare a tax return, but if I can't tell you why or help you with it, then how much value am I really adding? So I try and hit both sides of that, both the compliance and the value add.
Well, and I would just like to sing your praises that I really appreciate your not just your expertise, but your willingness to answer my questions. At least you've never come across as annoyed. I don't know, maybe you are, but you're just you hide it well. But not just that, you're very responsive. You're timely with your responses, and that's so important because, as you well know, I made a move in 2022 that I regret, but it was because I could not get a hold of my CPA and I got mad. And so I just did what I wanted to. And
Yeah.
sorry.
Well, I've seen with my real estate path as well that how important that is. We've been through 2 agents because of that. And when you're dealing with foreclosures and investments, you got to be quick. You can't wait 2 days to even go see the house. The property's gone by then. If it's that
Yeah.
good of a deal, forget it. So, that's one of the things that we strive for here at SRH. We are not the cheapest firm in Clarksville. We are somewhat cheap compared to Nashville, but that's not our goal. Is not necessarily cost savings for our clients from a fee perspective, but we try to save them fee, taxes so that it covers our fee, to say the least. But really, it's about service. We're in the service industry, so if you can't depend on us to answer a question, then what are you paying us for? You can go to H&R Block and get that kind of service once a year.
Exactly. Exactly.
We're not. We can't charge you for a steak dinner and give you the fast food. So, so that's part of our goal here, is to try and get back to our clients as quickly as we can. And I mean, I do have times where it might take me a day or two just because I'm not in the office for whatever reason, but we try to get back to our clients and just answer the questions as best we can.
Is certainly acceptable as compared to some CPAs. It's a month or two. So
that would be rough.
So just very quickly, because I know you've got another meeting to get to, how can folks reach you? Email, phone number, do you prefer?
Email is the most ideal. You can call me and I will get back to you, but email makes it easier to either answer your question if I can without having to I say without having like it's a bad thing, but it's hard to reach everybody sometimes, whether it's me calling you back or you calling me back. You can play phone tag. Email is ideal, but if you need a phone call, I'm more than happy to schedule a phone call by email, or just give me a call and I will call you back if it needs to go that way. But email is definitely my preferred method of contact, because I'm sure you've seen I work some different hours. I'm usually in the office by 5:30 or so I can respond to a lot of emails before I start getting barraged with phone calls. And that's helps me keep up. And sometimes I'm in bed and I get a text at 9:30, I'm watching Netflix, and I don't mind responding to an email if it's something real quick. So that's probably the fastest way to get a response from me, but I'm open to phone calls obviously too.
So I will put your email address in our description when I post this video, but for folks listening, do you mind to tell them your email address?
Sure. It's D as in David, FITCH at S as in Stone, R as in Rudolph, H as in Henry, CPAS.com. I know is a mouthful. dfitch at srhcpeas.com. So Stone, Rudolph, Henry, certified public accountants.
Got it. All right. Well, thank you so much, David. It's a pleasure, and I'm definitely going to ask for you to come back. I think there's so much more that we could cover. So
I do have a few other things on my list that we didn't quite get to, so we'll do it again. And I'd say probably November, December timeframe is usually great, because that's when we're doing our tax updates. So I could, give you a kind of a tax update just from an individual perspective, and then we can go into some more real estate stuff if you wanted to.
Sounds perfect. Thank you so much. You have a great day.
All right, you too, Chris. Thank you.
Bye-bye.